The things I'm worried about are the fundamental factors. Economics, earnings growth expectations are too elevated, economic expectations are too high, valuations are too high. Those are all very problematic. Now, they're not problematic today, they're not problematic by the end of the year, but I think they become problematic next year. I think the headwinds are building. I still think next year we could see high volatility and lower rates of return because of the other factors that are still building in the system.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the peripatetic portfolio manager, Lance Roberts. Lance, I'm going to ask how you're doing, but I already know not great.
Yeah.
You got a head cold, it seems.
Yeah, I do. I do. So if I start sneezing, coughing, wheezing during the conversation today, just sorry in advance.
Hey, yeah. Hey, well, that's what the mute button and the editing is for. So
Exactly.
don't worry. Well, I'll say this. I always sort of fail when I make this commitment, but we'll try to end this one a little bit early to save you your voice. But I appreciate you. I appreciate you soldiering through.
Sure. Yeah, no worries.
Okay. All right. Well, look, Lance, some interesting things to talk about. There's all of a sudden, some palpable concerns about AI in the world,
Uh-huh.
and we'll talk about that in a moment. But first, I want to mention two quick things. One, I just returned from the New Orleans Investment Conference. It was a great experience as usual. I always have a really good time there. Um, it is, Lance, I really want to bring you one year, because I think you'd like it. Matter of fact, I think you'd be a great speaker there too. But it's one of the times of the year where I get to sort of mingle with a lot of people, a high concentration of people that watch this channel.
Right.
And I got to say, I feel guilty because I get so much wonderful feedback from folks. And it's folks, if you're one of them who came up and saw me in the hallway and said something nice, thank you. It is the absolute best experience for me. But I do feel guilty because I feel like so much of the goodwill that they have and what they're reacting to is the generosity of the guests who come on this channel. And Lance, you're one of the ones who comes on most frequently. And just so you know, there is a lot of love for you amongst the people out there. A lot of the people that came up to me said how much they enjoy you, how much they enjoy these weekly market recaps. I had
Awesome.
one or two people say, yeah, but you know what? They're kind of long. It'd be great if you could shorten them a little bit. And then the rest of the people around were like, no, this is when I get my lawn mowing done or I get, whatever. And I've got a trip I've got to make and you guys are what carry me through. So
Yeah.
sorry for those who want these things chopped down a little bit. I think the market has spoken and it likes the longer format. But Lance, there is a lot of great goodwill for you. And what's amazing is it's all over. It's all over the age spectrum.
Yep.
Obviously a lot of retirees there, but a lot of kids. I mean, even some teens saying that they really enjoy this channel and really enjoy kind of the life riffs that we go on at the end. They
Right.
feel like that's really useful content. It's very geographic. A lot of people from Australia saying, "Hey, I like that Lance. He's great." You know. So I want you to feel some of that love, but also those of you again who either went or who send us very kind emails or comments under these videos, they totally are noticed, they totally are appreciated, and they really are what kind of keep us going, doing what we're doing here. So thank you. And anyways, Lance, a lot of that goes to you.
Yeah, no problem. That's awesome, actually. So yeah, I'd love to go sometime. It'd be fun.
Yeah, yeah. And I know, we both kind of work out of our offices, so we don't get to mingle with real people all that often. And I know you got a lot going on in your life, so you're probably reading feedback and stuff like that a little bit less right now. So again, I just wanted you to hear it. And again, a lot of real concern, goodwill, hope, best wishes for you and your family too, your wife and all.
Well, thank you very much. That's most appreciated. Good news is we have chemo this coming Friday, next Friday. So Michael Leibowitz will be here. I don't know if that's good news or not, but the good news is we're two-thirds of the way through. So uh, almost there.
Okay, that's good. So two-thirds, so wait, this would be number
Number
five?
four coming up. Four of
Number
six.
four. Okay, so you're about to be two-thirds of the way through.
Yeah, yeah. So next Friday
Yeah.
will be two-thirds of the way home. So yeah. But yeah, she's doing great, and she's keeping her spirits up, and she's up out working. She's actually interesting enough. We're going to talk about AI today. She's working very closely with one of the major, like the major AI company. I can't tell you who it is, but you can probably,
Well, the major AI company, I think we
yeah,
all know.
you can probably figure it out. But I'm building out power for a data center. So, it's very interesting that this is, kind of coming full circle, but she's out there killing it and doing a great job. So hadn't slowed her
All
down yet.
right. Well, so that's great to hear. I do know it's got to be a little rough for you right now because
Yeah.
I think you were saying because of her treatment, her immune system's suppressed. So you got this cold, you kind of have to keep yourself at a distance, right?
Yeah, I do. So when we bought a house that was built in 1963. And remember when I was living in the rental house, a couple of years ago, we would talk
Yep.
about this, is that we bought this house that was built in 1963. So it's a little small house, and we remodeled it, and it needed a ton of work. So it was pretty much a remodel from the gut, from the studs out, and we had to do a lot of fixes and updating, those type of things. So but part of that process is that it had just a two-car garage downstairs, and so I tore the garage down and I built an office above the garage. And so I have my own little man cave up here. So this is where I'm actually broadcasting from right now. I've got my computers, I've got my workstation, I've got my videos, and then I've got a whole, like, movie theater on the other side of this. So pretty much I've been relegated to my man cave now for the next week.
Oh, goodness. So
Longer.
you're like sleeping on the couch, watching old Clint Eastwood
Yeah.
movies and door
Yeah,
dashing.
so she leaves food at the bottom of the steps for me. She yells at me. She goes, "Go get your food." So I go out there and get it. So hopefully I'll be well enough soon to actually see my wife again. This would be great.
All right. So she feeds the dogs, and then if she remembers,
Yeah,
she feeds her husband.
exactly, exactly. I just
Yeah.
usually get what's left over from the dogs most of the time. So they eat well.
All right. Well, I hope you recover soon and could be reunited with her.
Yeah.
All right. And real quick to your point on maybe we'll talk about this in a little bit, but to your point about powering AI, big topic at the New Orleans Investment Conference. There seems to be, I think right now, a lot of recognition amongst our community, Lance, which I would kind of call like the community that's paying attention, that there does seem to be an imbalance or a mismatch between the size of the opportunity with the energy needed to power AI and the pricing that's going on in the energy markets, in the fuels that are going to be used to power it, notably, natural gas, um, and obviously the companies in this space. So one thing I want to let folks know is I get to spend a fair amount of time with Rick Rule at the conference, and told him, I said, hey, I don't know if you're going to do an oil and gas boot camp anytime soon, Rick, but I think it's something that would be of great interest to this audience. I mentioned it I can't remember if I mentioned it on a video this week. I think I did with Stephanie Pomboy maybe. And the folks just want to know the result. I totally saw your feedback that said absolutely. So I talked to Rick. Unclear whether he's going to be able to do a boot camp anytime soon, but he said if I can't do an official boot camp, I'll happily do, one or a sequence of, here's my thoughts on where to invest in oil and gas for your audience. So folks know that I'm putting that together in the works. Lance, if you and Michael want to do anything like that similarly as well, we could dedicate one of these.
I'm kind of chuckling because Mike and I actually started building. So, on the SimpleVisor platform, we've now added several thematic portfolios. We have
Yep.
AI, crypto, small mid cap, high growth stocks. Those. We have the all weather model, which has gold and precious metals in it, and we are actually building a oil and gas centric thematic portfolio that'll be up on SimpleVisor here very shortly. But it's going to be the stocks that are directly related to the oil and gas drilling sector, the production side, and the transportation side that'll be needed to help feed into, and then including natural gas, feeding into this power center data generation process.
Okay. How close do you think? A couple weeks, a month?
Probably I should have that portfolio up next week.
Really? Okay. Well, what would be great, I don't want to be too greedy here, but what would be great would be maybe on one of these weekly market recaps, we get both you and Mike on, and you guys sort of walk us through how you constructed the portfolio. Maybe we do a live version of this where people can ask questions and stuff like that. I know that I sense that would be really appreciated by the audience. And folks, if that's true, again, validate me in the comments here below. But
So
there just
just
seems to be one of those moments, sort of like with precious metals miners, like a
yeah.
year ago, where folks were just saying, look, the metals have moved so far, the miners haven't really picked up. This sector is likely to catch fire at some point. Then it did. People are sniffing something similar
Yeah.
in the energy space.
And in the energy space, I think it's going to be a little bit longer. This is going to be something if you build into this portfolio, then you have to have an expectation of holding this for 1 or 2 years. I think oil prices get worse before they get better. So
Probably. Yep.
you buy the portfolio today, be prepared to be down 20-30% in the portfolio before it bottoms and turns back up. But this is going to be one of those portfolios that you need a dollar cost average into over time and and build into the position. So, but yeah, I think it'll be I do think there's going to be a shortage of supply relative to demand in the near future just because of what's needed to not only build data centers, but don't forget about all the impact on oil that's just consumed in the construction process of data centers, not just the power. We're all thinking about the power generation side, but don't think about all the use of that that's going into just the building of the building of the center, the products used inside the centers, the miles and miles and miles of cable and
Right. To mine, refine, transport, construct. I mean, all that's
all
fossil
that.
energy. Yeah.
Exactly. So yeah, I think there's a really good opportunity. Mike and I are working on that now. So now don't forget next week, like as I said, Mike will be here with you because my wife's chemo treatment is there. So he can certainly go through the portfolio with you next week. But if you want both he and I to do it, it'll have to be the following week.
Okay. All right. Well, we'll talk to Mike and see what works. I'd like to have you both there if this really was a team effort so that you guys can kind of, you know, play off each other's insights and stuff like that, and then
Yeah.
also let
That,
folks ask. But we'll do what works for you and your
yeah,
schedule.
and you're not going to miss anything. If you do it this next week, we've been working on this. He knows exactly what I think. He knows where he thinks. We're very much aligned. So we'd probably just be sitting there nodding at each other the whole time. So,
Okay. Okay.
but
Okay.
yeah,
All right. Okay. Well, good, folks. We'll one way or another, we'll make that happen. And then last, before we get to the good stuff here, just want to note for folks, I mentioned, I don't know if I mentioned on this channel, but I mentioned on social media a little while ago that I was going to do a fast, a 5-day fast. Just started it. I was going to do it a week ago. It got delayed because of the travel with the conference. But I'm here on day 2, Lance, and everything's going fine so far. There was a joke somebody put in on X saying, "Oh, I can't wait to start watching the next couple videos where Adam just rips the heads off all of his guests because he's so hangry." And,
probably true.
and good news, I'm not there yet, folks. But we'll see. We'll see what happens. But I do this periodically, folks, and I like to be transparent about it when I do, because there are a lot of people. I think there are a lot of benefits from it, and maybe Lance in the rant or some point we can talk about this if you want. But when I've mentioned this, I've seen a lot of people say, "Oh, I've never done one, but I've sort of thought about it." And you know, I think there's a lot of benefits you can get from doing a fast if you just like stop eating. It's not a good way to do it. You actually, I strongly recommend following a process and a protocol. I'm doing a specific one, but I'm posting on X. I've got one of those scales that measures a whole bunch of body, percentages from you. So I'm just going to post that every day, so you guys can see what happens to a body during a fast. The key thing here, as I've mentioned before, that I'm doing it for, is autophagy, which is when your body starts going into a fasting state, it actually starts harvesting your cells, breaking them down and rebuilding them for what's most needed by the body, but it targets your older and more damaged cells first. So there actually are some very scientifically proven health benefits from fasting for a moderate amount of time.
No, I
So
think that's right.
forgiveness in advance if I get snappy with you by the end of this discussion is basically
No,
what I meant to say.
yeah, don't worry about it. I mean, my son was home over the weekend for his birthday, and he was just eating everything inside the house. So if you ever really want to talk to somebody who does a lot of fasting, talk to my son because when he runs out of money, he's on what he calls ice soup, which is
Oh, right.
where he's just basically drinking water because that's all he can afford. So yeah, he's an expert on fasting right now.
Right. Until he gets to your house and then his big,
Yeah.
yeah,
No, yeah. He
yeah.
he definitely cleaned out my pantry before he went back to school. So yeah.
Okay. Well, I'm sure there's some people here saying, guys, just get to the good stuff of the market. So we'll get there now.
Okay.
So as I mentioned at the beginning, there's, the narrative around AI is suddenly striking a sour chord or two.
Yep.
Nothing, totally in crisis mode, but we had a couple of things this week happen this week that really kind of caught the attention. First is we were starting to talk about last week, Lance,
Yeah.
the earnings calls of a lot of the AI companies didn't instill confidence in the AI space for one reason or another. Most of the stocks are down fairly notably. I'm going to bet you got your entry point in Meta that you were looking for because I don't think Meta's done that well
We did.
since. Um,
Yeah, we did.
so
We've started building a position in Meta now.
okay, and we'll get to that in a sec. But uh, you know, people are saying, "Wow, all right, well, that's kind of weird." It's sort of raising questions like, "Is the top in? Did we hit the top right?" And then in conjunction with that, you've had AI, sorry, OpenAI, um, kind of float a trial balloon for like a pre-bailout guarantee from the government that, hey, if we get in trouble, we're really hoping that the government's going to offer some guarantees here so that we can, all the guys that are building the whole AI infrastructure feel comfortable and confident to go ahead and continue doing that. That got a lot of blowback in the press. Now, Sam Altman and his CFO have come out and given some qualifiers around that to say, well, that's not exactly what we meant. But I think a lot of people think, yeah, it probably was. Like you were probably just testing the waters to see how much the government was going to stand behind you. And there are some things they mentioned that I do think make some sense for the government to consider some loan guarantees on some of the infrastructure that's being built out, but in a way that the government would end up owning the infrastructure, not these private companies. That's maybe a different discussion. And it was notable that David Sachs, the national AI czar, he was very quick to come out and say, "Yeah, we're not doing bailouts for anybody in this space. We got a
Yeah.
lot of big companies racing for this, and if one stumbles, the other will step in." Go ahead.
No, yeah, look, a lot of this is just a bunch of mouthing rhetoric. So, what OpenAI was saying is like, hey, we need cheaper financing costs, right? So that's one thing. And then the government comes out, David Sachs comes out and says, yeah, we're not going to bail you out. Look, at the end of the day, so just imagine this. So you've got all this circular financing going on between these companies, right? So you've got NVIDIA invested into AI is invested into Oracle, Oracle's invested in whatever. So everybody's just financing each other to create this future. So can you imagine that you're the president or you're the congressman or wherever up in Washington, and all of a sudden OpenAI says, "Hey, man, if we don't get a bailout, this game's over." And then all of a sudden you've got Google, Apple, Amazon, Meta all on your doorstep as a congressman saying, if you don't provide us some funding for this,
Right.
you're out of office next time because we're going to fund your candidate that will do this for us in the upcoming election. So, this is all fine and dandy conversation. But here, let me just share a chart with you real quick, just to
Okay.
put this into perspective of what's going on.
All right. And,
Um,
and while you're pulling it up, let me just
yeah,
mention two more things that were sort of verbally covered in the markets this week. So one was the Jensen, I'm forgetting his last name, but the
Jensen Wang,
CEO of NVIDIA.
Jensen Wang, yeah.
Yeah. He said, hey, guys, I think China is going to win the AI race. They're only nanoseconds behind us. And that kind of caught everybody by surprise as well. And it seems like since that statement, the administration just announced that, well, we weren't going to give our best chips to China, but now we might even go down a level from that and prevent them from getting those chips as well. We'll see what'll happen. But basically, there's a lot of discussion saying, whoa, wait a minute, is this truly something that's we need to pay a lot of attention to, or
Yeah.
is this a guy who needs a lot of funding for the AI ecosystem, saying like kind of putting his gun to his head, saying, hey, look, you better continue to fund us, or else China's going to take it all, and we're
Yeah.
not going to win as Americans. So
Well, but Jensen Wang said again, you got to be careful. A lot of this stuff is taken out of context. What he said
I'm
was,
sure a
is that
lot of it's being taken out of
yeah,
context
yeah,
right now.
because Jensen Wang said, yeah, China's hot on our heels in terms of this, and it says if we don't go full throttle into building AI, they are going to beat us. So he was just making the case that all the stuff that's being done in AI has to be done because we have to win this race. If we don't win this race, China will. And so this is the space race that we had back in the 50s and 60s. This is a good thing, by the way. Back in the 50s and 60s, when we had the space race with Russia, it was all bets were on to get the first man onto the moon. And we developed all kinds of technology that did not exist previously because of that demand to beat Russia. If we had let Russia beat us, would it have made a big difference? Maybe, maybe not. But in the process of that space race, we developed microwaves, televisions, all this kind of stuff that we, the cell
Yeah,
phone actually came out from the space race. So,
I
all
totally get it.
this,
Let me just interject though,
yeah,
because I would say this isn't the space race.
it is
I
bigger.
would I would say this is the nuclear arms race, right?
No,
It's
that's
a
no,
because well,
no,
here's
it's
a question.
very
So if
different.
China quote unquote wins the AI race,
Yeah.
can America remain the superpower that it is?
Yes.
You think so?
Absolutely, because China doesn't have, look, China's got a huge demographic problem. They're a communist country, so again, you just can't develop the capitalistic system that we've developed here, that has developed the economic power that has come out of the U.S. and over the last 50 years. So yeah, I mean, but yes, if China beats us in the AI race, it's certainly going to be important, but it's
Yeah.
not nuclear weapons. This is very much akin to the space race because of all the technology that will get developed off of AI.
Right.
Don't
Well, a
forget,
ton of
AI is just
technology
the
was
beginning
was
step.
delivered. Yeah, but
This
a
is
ton of
just the
technology
initial
came out of
step.
World War II too. I mean, it's a
Yeah, yeah,
similar.
absolutely. So this is the foundation. This is think about it this way. You were alive with this, with the dot com with the internet, right? When we first created the internet, everybody's like, the internet's a fad. We're having these same conversations about the internet back then. It's not gonna, no, nobody's gonna use the internet. That's just crazy talk. And now we use the internet every single day. And what has come off of the internet has been just phenomenal for advances in productivity and health and science and medicine and all these other things that we weren't able to collaborate and do previously, has
Yeah.
just expanded our lives enormously. So we do have to win the AI race, and I potentially think they will. But yeah, I wanted to go back to show you this chart because this is exactly what you're talking about here.
Okay.
This
Sorry, I
is
took it down because I thought we were going to take
I
another
don't
sidetrack there. So
no,
finish
I
your
just
thing here. Just for the record, I'm going to disagree with you. I'm going to say this is something it is existential for America the way that the nuclear race was. We can disagree, but
yeah, yeah.
this may be a theme we continue discussing. Probably will be for the next bunch of
Well,
months
all
and
I'm saying
years.
is that we developed the nuclear technology for weapons, and that was about all that occurred out of it. We didn't develop a vast amount of new products, services, and things coming out of the nuclear race, right? So I mean, yeah, we developed nuclear warheads and we developed a lot of very destructive things, but that was a deterrent to keep everybody from going to war. I'm just saying that from a positive perspective, you're going to get a lot more positive benefit out of the development of AI than you are out of nuclear weapons.
Yeah, and you probably will. I'll just mention this, and then we can talk about it later if you want.
Yeah.
What I'm also seeing in the past week or two in the media is more than I've seen in the past. The question is AI going to become the villain in the story? In other words, they're starting to ask the question about jobs, right? It's starting to come up in quarterly reports and jobs reports that, companies are saying, hey, we are not hiring or reducing, our workforce because of AI. And it's you and I have been talking about this forever, so this isn't a surprise, but it's just entering the media dialogue in a way that I haven't really seen it enter yet of like, hey, wait a minute, are we sowing the seeds of our own job destruction here?
Yeah.
And again, that's not a new idea, but I'm just seeing that being asked a lot more right now as people are sort of taking a step back over this past week or two and saying, whoa, wait a minute, is AI really everything we thought it was cracked up to be?
Well, no, look, we destroyed a ton of jobs with the internet too, right? I mean, you used to have receptionists at desk, and we don't have that anymore,
I know. I
right?
think this is going to be way bigger. I
It,
can't remember where you fall on that. I think you do too, but
yeah, no, you are definitely going to have job destruction from an AI. I mean, you're talking about why do I need paralegals when AI will do it for me? But there's a long way to go between now and then. Mike and I were just running an interesting test this morning. We were asking Grok the exact same question. We were typing into Grok the exact same question. Who were the best 10 presidents in US history? And we got different
hmm
answers,
hmm
right? And so you can't, so if I'm running a legal case, I can't have different answers because I'm in Texas, a conservative state, and he lives in Maryland, which is a liberal state. So we're getting different answers because of the state we live in.
Oh, that's interesting. That's so interesting. I thought you were saying like, well, it's not perfect yet. It still hallucinates or whatnot, but you're actually saying it's
It's
giving the user a different answer
Yeah,
based on,
based on
okay,
biases, states. And I don't know where
right,
it got. I don't know all the background of
right.
where it's dragging a state, but that's the only thing we could come down to
Yeah.
is that we
Although it's
just live in.
interesting. I mean, is that a wrong answer or you asked it a subjective question, which is best? So maybe your definition of best is different than Michael's
Yeah,
definition.
and that's the point though, right? So if I'm asking a very specific, now we did ask some very specific questions, right? So we ask it some basic math questions. We ask it as an example, we ask it specifically where the market closed on a specific day, and
hmm
those would give us very factual. details, it could answer precisely. And we
Hmm.
got the exact same result from that. But anything that had a slight subjective to it, we would get different answers because we live in different states.
Hmm.
And so, but so my point though is that when it comes to that, say, if I wanted to ask it, how to cure cancer, we might get very different answers from that because what I'm saying is that AI needs to move past the point to where we're getting very subjective answers based
Hmm.
on our search history, our states, those type of things, and give us more factually based answers. And that's what I'm saying is like, if I'm a paralegal working on a case, as an example, because this is one of the areas that AI's, people are worried about AI replacing those jobs. I can't be getting different answers on legal status because of the state I live in,
Yeah,
right?
yeah, you
Type thing.
can't. And I kind of get worried about getting in these discussions about like how AI is, results are imperfect right now because it gets so much better, so much faster that like, yeah, you're absolutely right today, but in a
Mhm.
year, in 3 years, like a lot of this stuff maybe have been completely resolved by then, and we don't know. But just looking at the trajectory, we don't. I will
Yeah.
listen.
So,
Yeah,
but my point is I agree with you. It is going to
yeah,
be a job replacer, absolutely. And so you better learn to work with AI and not just sit around and go, "Oh, AI is not going to hurt me." Because
right,
again, there's a lot of people in trade business, as an example. There are electricians, plumbers, etc. Like, "Oh, I'm not worried about AI. AI can't do my job." You stick AI in a robot, it can do your job.
right, or it
And
will within a short period of time.
yeah,
Yeah.
yeah. So, nobody is immune from AI. So you better learn to work with AI and understand how to adopt AI into your process because it will replace you if you don't.
Okay. Yeah, totally agree. Um, all right, I had one more AI thing to say, but look, I want to get to the
Well,
chart. So pull up the
yeah,
chart
yeah.
you were going to
So we'll
say, and
go
then
back to
let's.
the start. No,
Yeah.
my whole point was is that you got to keep things in a little bit of perspective. So that's why I wanted to show you this chart. So this is MGK. So this is the ETF that tracks the mega cap stocks. Now, there's other stocks in it other than the big Mag 7, but as a proxy for the Magnificent Seven, MGK is a good. This is the mega cap growth ETF. Um, and so this is a weekly chart. I just wanted to show you this because this is that big red candle. So this week has definitely been a tough week for the Mag 7. Absolutely no way around that. But the Mag 7 was pushing three standard deviations above its long-term weekly moving average last week.
Yeah.
So this has just been the markets were extremely overbought, and on a relative strength basis, you're very overbought. And if we go back in history, here's back in we had back in kind of March of kind of 2024, we had the whole DeepSeek thing, and the market sold off, and everybody's like, oh, it's over now. DeepSeek's going to replace Nvidia, and then that was a good buying opportunity. And then we've had a lot of people come along and say, "Oh, well, Mag 7's going down now, so it must all be over." And then that's been a great buying opportunity. So, as I talked about before, we're very early into this whole AI development chase. So if you go back to the development of the internet, what was going on back then, we're still very early into this. There's going to be a lot more to come out of this in terms of this. So it's way too early to be calling, this to be over because of just somebody said something or somebody did something. You got to look at where things are going. And these stocks were extremely overbought. Palantir certainly pulled back this week. But they had run up 10% into earnings and then sold off after earnings. And they were almost four standard deviations over about that point. So things were just extremely extended because of this April through, you go back and look at the lows here in April. This April through October run was just outstanding, up 35% in basically 5, 6 months. You're going to get a correction here at some point. And look, breadth has been terrible. A lot of the underlying internals have been very weak. So you should expect a little bit of a cooling off in the market, but that's going to very likely be a good buying opportunity heading into year end because again, we go back, stock buybacks have now started back. That's 5 to 6 billion a day. Corporate managers are way underweight technology exposure going into year end. They've got to get technology exposure back on their books, and this sell off certainly not helping that at all. But they're going to have to gross up on tech exposure because they're underweight tech going into the year, and they've got to rebalance their portfolio. So again, there's and you still have a lot of momentum. There's still a lot of buyers out there just waiting for an opportunity to get money put into work. There's a lot of cash still sitting in there. So again, I think these kind of conversations are good. It's great to certainly analyze the negative comments, but I think you got to look at the broader long-term trends, then come back to the technicals and just realize that things were very overbought. You want corrections so you can buy these positions into your portfolio. And again, that's kind of you want to keep that process in mind.
Okay, and that's where I was going with this.
Yeah.
So, we've talked in previous weeks. Um, I'm thinking about the interview with Mark Newton from Fundstrat, who
Yep.
said back at the beginning of October, "Hey, I'm still bullish, but I think that October, November could have a downdraft for the market, or yeah, pullback for the market. But I think that's going to be a buying opportunity and then rally into the end of the year." I haven't talked to him recently, so I don't know if that's still his case, but I know that you were sympathetic to that, Lance. And so it seems like you think that, yeah, this probably is a buy the dip opportunity here, especially in some of the Mag 7 names, and that you still think it's more likely for the reasons you just mentioned
Right.
stocks will likely pick up and end the end of the year stronger than they are now.
Yeah, we've had a lot of people come out. We've had people, talk about shorting Nvidia because of this, that, or the other thing, and those have been actually good buying opportunities when those type of commentaries come. So again, just I think that's just for us, right? I just think we're still early in this cycle, and I think there's more upside than there is downside at this point. And again, it doesn't mean there's not going to be a lot of volatility along the way. You're definitely going to have pullbacks. But I think on those pullbacks, and again, you have to be specific about the stocks that you're buying too. I mean, there's a lot of companies out there that are in the AI space that I wouldn't touch because they have no revenues. So make sure you're buying good quality companies and make sure you're investing in the right areas. But I think there's going to be long-term opportunities in some of these things as this cycle continues to mature itself. Now, the downside risk to that is that this all turns out to be a big puff of smoke. AI never works and it goes away. Yeah, that's
We
gonna be a
talked about
problem.
this last week
Yeah,
that I mean, I don't think anyone really thinks that AI is going to be a nothing burger. But if it turns out that the expectations are that, oh, this might take a decade or two longer than we thought to fully materialize and all that stuff, you had said catastrophic is too big of a word, but it would be very injurious to the markets as the
yeah,
markets reprice for that. And we talked about that would create a negative wealth effect that would then impact the economy. So I mean, it would be a big deal if the bloom truly fell off, the AI rose, but we don't know. And that's one of the issues when you're in a capital expansion. I'm trying to avoid using the word mania right now, but I mean,
yeah,
because nobody knows how high is, right?
yeah.
Like with the internet, everybody knew it probably had a limit, but a lot of people thought we were near it at the start of 1997, and there was still 3 more years of unbelievable gains to get before we hit the limit.
Yeah, exactly. And look, this will end. And just like we saw in the dot-com crisis, there's a lot of similarities, and I don't want anybody to think that I'm dismissing the risk because I'm not. We're very sensitive to the risks that are building in the marketplace, valuations, earnings expectations, et cetera. There's a lot of concerns out there. But again, these can run for a while. And again, when we got to the dot-com era, there was a lot of problems, that developed. The Enrons, the Lucent technologies, the global crossings, the MCI data centers, and they were all building out this fiber optic cable, and it wound up that we didn't need it for the internet, and we had all this dark cable, and then
Well,
we
we
talked
didn't
about
need it
last week.
yet. We
Yeah, we
didn't need
did
it
that.
yet.
That's my whole point is
Yeah.
that, that's the risk to the markets is that there's all this build out of data centers and all these earnings projections based on what these data centers will provide. And it doesn't matter that if that eventually becomes to fruition, but let's say it's 10 years out and not 5 years out. And that was the same thing with all this fiber. We built all this fiber. We just didn't need it for another 5 years until Google came along and said, "Hey, I've got this idea for YouTube." And there was all this fiber optic
Yeah.
cable for them to push video through. So if the earnings reality becomes more extended, and let's say it's 10 years to hit that mark versus 5 years, that's going to be a real problem for valuations in this market.
So, Lance, on that point, I've actually had a number of discussions about it this week, some on this channel already, but I don't know if I've had it with you yet, which is this is pretty much how all transformative infrastructure eras begin is you get this overbuilding. You get kind of this mania where everybody sees the potential, capital chases after it, right? Nobody knows how high is, and then eventually they get a better picture of what demand's going to be like, and
Mhm.
they realize, okay, we passed the overbuilding point. There's a big correction, right? And then kind of out of the rubble, right? The bubble burst survivors and new companies then come in
Right.
and build the sustainable businesses off of that new infrastructure, right? And we saw that in railroads, we saw that in the dark fiber of the dot-com era. One of the questions I've been hearing raised here is, hey, it may be different this time. So if we end up with a bunch of dark compute, right, a bunch of data centers that we don't really need right away because we overbuilt, right?
Hmm.
The shelf life of the chips in those data centers in terms of their power and capabilities is finite. In fact, it's relatively short, right? So in other words, back in the railroad days, if you didn't use a railroad line for 5 or 10 years, the iron was still good. You could still run a train on it, no problem. Same thing with the fiber optic cables, right? If it took 5 or 10 years to finally light that up, fine, it
Right.
worked just fine. But these chips that are sitting there in the data center may be just tremendously less powerful than chips 2, 3, 5, 6 years around there. And I don't know what the depreciation of a data center is, but I'm pretty sure it probably depreciates a lot faster than, say, iron, right? Or silica.
Yeah, and this is actually you're hitting on one of the concerns that Mike and I have been talking a lot about lately is the life expectancy. So Nvidia's got a really good position in terms of this because they're building the chips, and those chips age out very quickly, right? Because new technology is coming along. This chip's faster than that chip. It does this that didn't do, etc. So every time, so if I build a data center, right, and I've got this data center built, the problem that I see for the data centers is the guy actually constructing the data center because he's got to constantly be upgrading that data center
Hmm.
for the latest chips, technology, etc. Because if he doesn't, somebody's going to build a better data center down the street with the latest new technology, and the data is very portable. I can just lift it out of this data center and put it in that data center over there, no problem. And so, NVIDIA's got a really good moat around them for this. The area that I'm a lot more skeptical about investing in is the guy actually building the data center, right?
Yeah.
I think there's going to be a real issue with that. So, think about digital realty REITs and some of these real estate REIT companies that are building these data centers. They're looking at this, oh yeah, I'm gonna build this data centers with this long-term cash flow, but I'm not sure they're actually pricing in how much consistent upgrade is going to be required on those data centers to stay up with the latest technology.
Yeah, this is going to be really interesting, and I've heard from some folks that they'd love to learn a little bit more about this, and it's pretty. I hope it's pretty clear. I'm not an expert in this. So, folks, if you'd like me to bring in somebody who's kind of a data center expert to talk about this, again, let me know in the comment section below, and if there's enough interest, I'll go out there and hunt for somebody to do that. All right, I want to, Lance, in just a second, just get to the general TA on the S&P. If that chart looks any materially different than the one you just showed us for the semiconductor industry, I mean, AI is so much now a part of the market
Yeah.
that maybe they're the same and it's not worth showing the same chart twice. But
No,
before,
no, no. There's more to go into on the TA side. So whenever you're ready for that, we can
well, I
jump
just
into
want
the charts.
to bring up something real quick here, and
Sure.
it's just total human interest, folks. It's only because you were talking about the the great technology that we got out of the space race, and I mentioned World War II and whatnot, right?
Yeah, yeah.
So here's just an example I saw this morning that really caught my eye that I thought was really cool. Um, all right, so this image, Lance, let me see if I can
Huh?
blow it up here.
It's Christmas.
Yeah, this is the clearest image we've now ever had of the atomic level. So this is a molecule. And let me see here if I can pull up here. This is praseodymium. Um, let's see. Yeah, it's a praseodymium scandium oxide crystal. And basically, these are scandium atoms here, the ones that are bright, and the ones that are
Yeah.
dark are oxygen atoms. And you can see the atomic pairing here. It's unbelievable that we now have this level of clarity here at the atomic level. So essentially what this does is, I mean, it's really cool just to be able to look at. And if you're listening to this on the podcast, folks, you don't have the visual. I'm sorry. Go online and type in praseodymium and see what comes up. But one of the things you're saying is this is going to be really useful in basically like uh, coming up with new innovations because you can actually with now crystal clarity see how, certain structures happen at the atomic level, and then recreate them, in the real world, creating new types of molecules, atoms, whatever, right?
Yeah.
It's just it's an amazing time. And again, you throw AI on top of this and say, hey, AI, this is what makes the spider silk so strong. Make me something like this that's even lighter and stronger, right?
Right.
Yeah, just
No, look, again, this is my whole point about technology is that, I think, you've got to be careful thinking that everything's going to turn out the way the dot-com bubble did. There was a lot of things in the dot-com bubble that were primed for failure. I mean, just companies were committing all kinds of fraud. There was no revenue in a lot of these companies. Everybody was just sticking .com on the end of their name because that was, that was the thing to do at the time. And we're seeing, and don't get me wrong, we're seeing a lot of that today. I mean, we're seeing the same circular financing. We're seeing a lot of the same issues. There's certainly concerns out time, but I think that you got to be careful about assuming that everything's going to turn out exactly the same way. Because again, this time is different only in the standpoint that situations are different, backdrops are different. These companies have revenue, those companies didn't. I mean, there are a lot of differences that you have to at least pay attention to. Again, I'm not saying that everything's going to turn out to be just roses and it's just onward and upward from here. There's definitely going to be some bumps and hiccups along the way. But I think if you're a long-term investor in the AI space, that you're going to profit from it, but it's going to be bumpy. It's not going to be a smooth ride. You're not going to make 100% a year on your AI investments.
right. And I mean, who knows? And that's the whole point of what you're saying.
Yeah.
Personally, I feel like whether or not if whether or not we're in a bubble, whether or not it bursts like the dot-com bubble did, I would say you should be prepared for everything just to happen faster going forward. That's sort of what's happening here with the
Yeah.
technology. That's what happens over time, right? So we may go through a boom, a bust, and a recovery, but we may do that in a much more compressed cycle than we did before. Because I mean, how many years did it take for the Nasdaq to get back to where it was in 2000? Like 15 years?
Yeah. It's like 13, 14 years.
Yeah, it might take 3 this time, right?
Yeah.
And I'm just making up a number there, right? But
Right.
and to your point, this will likely be through that whole process, spinning off technologies that we may not even be able to imagine right now, right? Like
Right.
I'm pretty positive that now that we have that level of crystal clarity at the atomic level, that's going to enable some material science breakthroughs that you and I probably can't even if we just got a couple of beers and lean back and try to get as creative as we could be, might even exceed our own imagination.
Yeah. Well, but this all goes back to why it's so important in your portfolio that you have some defensive positioning within your portfolio. So just a good today's a really, really good example. Yes, AI is definitely under pressure today. So here, let me share this heat map with you. So AI is definitely under pressure today. Or am I not? What's going on here?
I hope that's not the market heat map. It looks like it's on
It's
fire.
it's what it says. I'm clicking on the button. There it is. I don't know why it keeps giving me a different window. Anyway, but yeah, you can certainly see, look, Google's under pressure, Nvidia, Eli
Whoa,
Lilly.
yeah, that's under pressure. Look at that, 4%, 5%.
Yeah. So you definitely get some pressure today. But look over here: Walmart, Costco, Coke.
Yeah,
These really boring companies: ExxonMobil, Chevron, Berkshire Hathaway. This is why you need to have some of these companies in your portfolio because days like today, where you're getting some of this risk off rotation, it's important to have this ballast in your portfolio. So, like right now, the S&P today is down, 1.24%, and our portfolio is down about 40 basis points, 45 basis points today because of that defensive positioning. So this allows you, having a well-diversified portfolio allows you to kind of weather through this storm a bit when these occur. But again, you want to keep this in perspective. You go, wow, look at Nvidia, it's down 4.75% today. It was just at an all-time high after a major run up in kind of over the last couple of weeks. It was 4 standard deviations above its moving average. So you're just getting a reversion back to the mean, which is what you should expect. And this is why it's important is that when these things do occur, you keep them in some perspective, or you're not just panic selling stuff on at a whim because,
got
oh my
it.
gosh, it's down, I got to get out of it. you know Having a ballast in your portfolio of some of these defensive positionings allows you to just look at what's happening in your portfolio as a whole and say, okay, am I still okay? Yes, I'm doing fine because I have these other positions that are holding up my portfolio.
So absolutely. Can you go back to NVIDIA for a second? I just have a naive question to ask you about it.
Sure.
Um, so, and well, let's start. Yeah. Okay. So, you see how it looks like it is broken down below the whatever that real long-term bright trend line is?
That's the 50-day.
The 50-day. Okay. So sure, it can go below the 50-day, it can go right back up. The fact that it's cracked beneath it, for a day
Yeah.
doesn't really mean too much. But if you look at the scope of time of it, um, if you look from what is that after April, right? So after Liberation
Yeah,
Day,
here's
it,
your April lows.
yep, it spent 4 or 5 months way above that average.
Yeah.
Dip below, came up, dip below, came up, dip below, came up, tried to get up again, now dipping below again. Does that suggest that like gravity's starting to weigh on the stock there and it's going to start spending some more time beneath that?
Yeah, no,
Technically,
it's very possible. I mean, you actually, here's the April low, right? But Nvidia had broken the 50-day moving average back in early January, traded below it, through April, and then finally bottomed and took off. So yeah, you could definitely spend a little bit of time here, somewhere between this 150, 160 level, and kind of working off some of this overbought condition. Because again, this is a daily chart, but once you pull back on weekly, so here's a weekly chart. You've had a monster move in the stock from basically 2024 all the way through 25. 2024, 2023, you were at $10 a share. You're now at, 160. So, you could have a correction back to 150-ish and still be in a very bullish trend for the stock.
okay, okay,
So again, this is why I'm saying you got to be cautious with taking 1 week's worth of action. And again, this is why we talk about taking profits, rebalancing, doing these type of things on a consistent basis. We've pulled so much profit out of Nvidia that we're just playing with house money now.
right at this time.
And
Yeah,
yeah, and so this is why you want to rebalance risk, buy stuff on opportunities. We're starting to build a position in Meta very slowly. That'll eventually be 5% of the portfolio, but it's going to take time to get there. It's working through a corrective process, which is good. We
all right,
want that because it allows us to buy, as it comes down, we can keep averaging into that price at a little bit lower level, lowering
yeah.
our cost basis. So we're going to work through that over some time. But yeah, I mean, long term, these companies are just killing it on revenue growth. So I definitely want to buy the companies that are growing revenue the fastest.
Okay, and maybe you just answered my question, but I was going to ask, so why do you love Meta so much?
Have you looked at the revenue growth on that?
Well, yeah, pull it up, pull it up. I mean,
Yeah.
because I think a lot of people are
And
thinking
again,
of it
look,
at
I'm
this
not a,
point as this may be the first also ran in the AI space.
yeah. So two things. One is that if you take a look at revenue growth, this is sales going back to 2006. Sorry, 16. And they have just continued to grow sales. This is what happens at the top line of their business, right? So
Yeah,
they're continuing to grow sales at a very rapid pace. EPS growth is just accelerating at this point also. And look, they're not creating any of this revenue off of AI. That's an expense on their books right now. This is just what their normal business is generating in terms of growth.
yeah.
So
How much of this is advertising? Like all of it?
all of it, they're not generating anything on AI right now.
I mean, unless they're using AI to sell ads
Well,
and
they
improving
are,
their
but what I'm
modeling.
saying is that their AI build out, all the stuff they're building on their data centers and stuff,
Yeah,
that's not generating any revenue for them yet. That's all loss, right?
right,
Because all the capex and everything's going into that. That's all cost. So this is
right.
all the revenue growth. And so this is the important thing is that I can buy this company that is growing revenue by leaps and bounds. And even if AI turns out to be a complete dud, they're still growing revenue on earnings. I mean, yeah, it's going to whack. It would certainly, whack the stock for a while because of the basically the waste of the capex that was done on building out AI. But AI could go to zero for them, and they're still growing revenue like crazy. So
Okay,
that's so and so there's three reasons why do I want to own Meta. Why do I want to own Meta in my portfolio? One, passive indexing effect. Every time somebody buys an S&P index fund to chase the market, they buy Meta, right?
sure.
And
But
we've talked about
same for the other Mag 7, but okay, yeah,
exactly.
right.
So I mean, it's just that's 40 cents of every dollar going into that stock or those 10 stocks every single time somebody buys an index. So you have the impact of that. Corporate buybacks, they're certainly involved in that. And then of course the revenue growth on the other side of it. So I mean, there's three good reasons why that, if I'm looking for position to play in AI, I can go and speculate in some of these other companies. Like for instance, I could buy, Oklo as an example, because Oklo is, in the nuclear space, is going to be there.
Yeah.
You
But
know,
he's got no revenues. Yep.
no revenues. All right. They generate, this is sales, zero. You know, I don't want to buy that company until they actually start generating some revenue. This is
Yeah.
all great. This whole run has been great, fine and dandy because it's all the expectation they'll eventually provide that. But what if it's 15 years out? What if it's,
Yeah, totally. But don't compare it to a storage stock. I mean, I guess what I'm wondering is like, why
yeah.
not one of the other Mag Sevens? Like, why is this one catching your attention so much?
Well, here's Apple. I mean, Apple's doing fine, but its growth rate of sales is basically flat.
Sure, get that. But how about Google?
Right.
How about Amazon? There's
We own Google, right? We own Google. We've owned Google for a long time. Same reason.
is it 5% of your
Owned
portfolio?
we've owned Amazon for ever since we launched the portfolios because of its sales growth. So at the end of the day, what we're looking for are companies fundamentally that can grow sales. And what I'm not interested in is companies that either have no sales or can't grow sales. Earnings are fine, right? But you got to remember, earnings are all manipulated. Earnings are, if you take a
Yep.
look at earnings per share, a lot of that is manipulation. A lot of that's corporate buybacks. About 75 cents of every dollar generated in terms of EPS growth is all accounting gimmicks, right? Only
Yeah.
about 25% is actual revenue. So what we look for, me and Mike, when we're buying stocks for our portfolio, are companies that are aggressively growing sales because that's what generates earnings at the end of the day.
That is. Let me ask you this. Do you look at free cash flow
Yes,
closely?
absolutely.
Because yes, you want revenues, but you do want something positive coming out at the end of the day.
Yeah.
And earnings you can't trust so much because you said they can be manipulated, but free cash flow is a little more honest, right?
Exactly. So then, and look, you can't really manipulate sales too much at the top line, and you can't really manipulate free cash flow. So again, and then there's also and also the reason we own Apple and Amazon. Sorry, the reason we own Amazon and Google and these companies is because of we recognize the passive index in the market, right? We recognize that effect on the
Right.
overall market.
Don't
So
don't fight the robot.
yeah, look, you have your choice. Like, oh, I'm not going to own them because I don't like those companies, whatever the reason is. That's fine, but it's kind of like trying to sell a boat without any sails up. Right? I mean, you're not catching the wind, and so part of the market gravity, that momentum in the market, is just that passive indexing effect. And until that reverses, you're just kind of really fighting an uphill battle, not owning those companies. So you have to own some. And then we feather around that with really boring stocks because we own Costco and Walmart and Procter Gamble and Berkshire Hathaway and JP Morgan and all these really boring companies that are out there just, doing their thing. But in days like today, when those Mag 7 are getting hit, those guys start kind of holding up the boat.
Yeah, they're saving your butt. I mean, they're
Yeah.
doing what they're supposed to do, right?
Yeah.
Yeah. All right, last meta question, and we'll move on.
Sure.
So I believe you still think that the economy is slowing as we head
Yes.
into 2026.
Yeah.
In a slowing economy, and I know you're not predicting recession, but in a slowing economy, when things start getting tight, companies start cutting their advertising budgets first.
Yep.
How much of a concern for you is that with a company like Meta that is like 100% advertising?
It's definitely a concern, and this is part of the conversation that we've had here for a while. You and I both is that when you start thinking about next year as an example. So this is a chart of earnings expectations right now, forward earnings. Let me enlarge this here before I share it. I just posted on X this morning. Um, Notice this is S&P 500 at the top.
Okay.
Um, and this is mid cap 400 in the middle and small cap 600 at the bottom. This is forward estimates. So this is 2025, but this is 2026 estimates, right? So this is forward estimates for next year.
All right. Sorry, let me just make sure people understand.
Yeah.
There are different companies in each one of these things, right? There's not overlap.
No, there's no overlap. So
Okay.
this is large cap, mid cap, and small cap.
Okay.
So Apple, Meta, Google, those are in large cap. And the mid cap is a totally separate set of companies, and the bottom, the small cap, those are totally separate. So no, there's absolutely zero overlap between these indexes.
Okay, good.
Okay. Um, so, but I want you to notice the sharp upward slope of this in terms of earnings growth. This is estimated for next year. Now, in 2023, 2022, 2023, 2024, let's just look at the bottom line. Let's look at small cap 600. They had negative growing earnings for the last 3, 4 years.
Hmm.
Yet the economy was absolutely bonkers on fire because of all the stimulus that we injected back in 2021, right? So we were producing, 4% economic growth. Everything's great. We've got all this stuff going on. They cannot produce earnings in that environment. Same thing for mid cap. Mid cap didn't really produce any earnings growth of consequence during that entire time. Now going into next year, they suddenly expect this massive resurgence in earnings growth in the small cap and mid cap sector, but the economy is expected to slow down. We should be running around 2% growth next year. Europe is going to grow around 1%. So the problem I have going in next year is really in the small and mid cap space, small and mid cap space, which are very economically sensitive, but they're expecting this massive earnings growth to emerge in an environment of slower economic growth. I think that's the risk to markets next year.
Okay.
And maybe
And I'm
I'm
just
wrong.
curious, Lance, if we were looking at this chart a year ago,
Yeah.
would it have had a similar trajectory in
Yes.
for
Every year.
2025 forecasted? I mean, that's kind of the way it always is,
It
right?
is. Yeah. And this is what
But
I'm
you
saying
think
is
the
like,
rubber may meet the road this time just because we don't have the pig left in the python of all that
I
stimulus?
I I think that is the risk that we're going to run into next year.
Okay. Well, I think that's quite real. So again, just tying it to Meta, does that slow your entry into Meta because you want to see how things are going, or you
Well,
just
no, don't forget that part of our portfolio management is also we have a little bit of a trading bias to it. In other words, we're trying to buy stuff cheap, and then if it has a good rally, we'll sell into it,
yep.
reduce our position size, and then we manage that risk over time. So, we're not just looking to buy something and hold it for the next 10 years. We're looking for opportunities of things that are getting really oversold, outdone in some shape, form, or fashion, where there's an opportunity. We buy stuff cheap, we sell it expensive. So we may own Meta for 6 months, we may own it for 5 years. It just depends on what happens next year.
Okay. And in terms, I know you're building your thematic portfolio for energy. Um, are you guys actively starting to increase your positions there at this point, or are you waiting?
No, we've actually, so one of the companies that we own, so now so that thematic portfolio is a little bit different because it's going to
Yep.
be 100% energy.
Right, and it's just going to live on as that thematic portfolio. Yeah.
Correct. So, but in our 60/40 allocation
Yes,
and then
that's what I'm asking about.
in our dividend equity models and our all-weather models and those type of things, where we own stocks longer term, then yeah, we own energy stocks now, but for instance, KMI is one of the stocks that we own, and yeah, we've been adding to that position on weakness as well.
Okay. All right. Good. All right. I might have, in all of this, we might not have actually brought up a chart of the S&P. Do we
We
need
have
to, or
not.
we already talked about all the,
Yeah, we haven't done the TA yet on.
all right. So yeah, why don't we bring up the S&P, and then if need be, why don't you bring up the, I don't know what you call the chart, but the chart with the quadrants that shows what's
Yeah, yeah.
looks overvalued and undervalued. Yeah.
Sure, we can do that. So this is the S&P again, where are flirting today with breaking the 50-day moving average. So this is the first time that we've actually done this in a while. So the last time was about 4 Fridays ago. We had that 2.7% sell off in one
Right.
day down to the 50-day moving average. So again, just because we're flirting with the 50-day moving average today, even if we close below it today, that's okay. That's not like, oh my gosh, I got to sell everything right now in the markets. We need to see if we stay below that next week. We can break these moving averages, but then we've kind of seen buy the dip, step in, and then
Yep.
immediately buy these things back up. So be a little bit cautious just reacting on a 1 day sell off. And again, we're recording this on Friday, and it's currently 11 a.m. Central Standard Time right now. So this market could rally into the end of the day and be back above the 50 before the close. So again, be a little bit cautious with this right now. We've got to see how the day closes, but we're working off that relative strength overbought condition. The one thing that has been bothering us lately a lot is this negative divergence in relative strength versus the rising market. That typically is not a very bullish sign and suggests that you could have a little bit bigger of a correction process on your hands. Also, breadth has been absolutely terrible. So we could very well work ourselves down towards this 100-day moving average towards 6,500. That would not be outside the realm of possibility. but probably somewhere between where we are now and 6,500-ish on the S&P, we're going to get very, very oversold. And that's going to be a good setup for a bounce into year end. So again, we're kind of getting a late October sell-off. What should have happened in October has got pulled into early November here. But I think at some point in here, we're going to work this off, and that'll give you a good setup for that year-end rally to close out the year. Because again, as I said, you've still got buybacks coming in, and portfolio managers in general are very underweight equity, so they're going to have to get, they're going to have to buy stocks and get it back on their books before year-end reporting.
Okay. All right. Look, well, thank you for walking us through that.
Sure.
All right. And I want to try to wrap up a little early today if we can. Oh, no, you're right. Let's do this first. Sorry.
Yeah, I was going to get you there. So, a couple of weeks ago, I had showed you this chart, and I'm going to show you two different variations of this chart. We're going to talk about sectors and then factors. A couple of weeks ago, I showed you this, and technology was extremely red, right? So
Right.
red is overbought. So technology was way up here in the corner, and now we've
And it
seen
was like
that.
the only one in that quadrant
It,
too.
it was, and back then we had a lot of stuff in the kind of this very lower quadrant, and so since then we've seen Staples. Staples was the most oversold. It's still oversold, but it's starting to come back again. That's that defensive rotation occurring. Real estate's been getting a little bit of a lift here, so we're seeing that money now rotating back from those sectors back into these more defensive sectors. Healthcare was really beaten up. It's now has moved up sharply here. It's now moving back into the kind of the overbought arena. So healthcare's had a really good rally. A lot of that's been Eli Lilly over the last week. And so stock that we own in a portfolio for the weight loss drugs. And there were some good announcements from the administration this past week. So we're seeing that rotation occur here. But factors is very interesting to me because this is more of what happens internally. Let me sort this. So for the last few weeks, gold miners, ARK Basket, ARK Innovative Fund, Kathy Wood and the whole ARK ETFs, those disruptive tech, those were really, really grossly overbought. We were seeing those up here. MGK, the chart I was showing a few minutes ago, was way up over here in this corner. That's all migrated back here towards the center, and everything that was very, very oversold is starting to work its way back up. So we're starting to see here's the momentum basket is now really oversold. Again, this is also discussing that this pullback in the market is now setting up for a good entry opportunity into some of these more aggressive positionings into year end, because what was really overbought that needed to get some sell-off done has been occurring. And now we've got momentum and small cap growth and buyback achievers here, disruptive tech. Here's ARK, very, very oversold. And so that's going to give them an opportunity to rally into year end. So again, the stuff that was really, really, really overbought has now gotten really oversold. And we've seen
Hmm.
some improvement, some of the more defensive stuff. So again, that's we're kind of clustering in the middle. So we may still see some of this rotation occur. And so again, it's not necessarily out of the woods just yet, but the setup here for a little bit better outcome by year end is starting to look a lot more appealing.
Okay. Let me ask you this real quick.
Sure.
Can you quickly just summarize how it calculates oversold and overbought?
So what this is absolute and relative performance of each sector relative to the index. Okay. So so this first column is absolute. So in other
And the
words,
index being the S&P, right?
yeah, so what's its so the first column is its absolute performance, right? So it's looking at the absolute performance of the sector itself. So this is more of think about like relative strength or momentum measures, right?
Okay.
So it's overbought in terms of its absolute performance, or it's oversold to its absolute performance. Relative is how it performs relative to the index. Is it outperforming the S&P or underperforming the S&P? So right now, for instance, momentum is underperforming the S&P. So this score range runs from -1 to +1. So if it's at 1, it's extremely overbought. If it's at -1, it's extremely oversold. So we're at a -48 on momentum. Now, just last week when you and I were on the show talking, MGK as an example. Here, let me take this off and let's just pull up MGK. So here's MGK. So last week when you and I were talking, MGK was at 0.98. It was up over here in this corner, right? It was almost as extremely overbought as it could be. Today it's at 0.02. So there's been a big reversion over just the last 3, 4 weeks. Here's the tail. This is where it was last week. This is where it is today.
Mhm.
So you've had this very sharp reversal in MGK just in the last week. So this is just looking at and this is why we how we build portfolios, and when we're constructing portfolios, we're looking at how these assets perform over time relative not only to their index but to themselves. Are they how do they perform relative to itself? That's absolute. How does it perform relative to the market? That's relative. And by combining these together, we can start modeling out how performance should react within the portfolio. And then that's why we own things like a Berkshire Hathaway as an example versus a Meta. Because if Meta's selling off, Berkshire Hathaway is probably gaining ground because of its defensive nature.
Mhm. Mhm. Okay, super helpful. Thanks. All right. Well, look, let's try to move on here. Um, we could talk for a long time about these next few topics, but let's just get your kind of high level thoughts on them, Lance. You wrote a piece this week, basically addressing the question, hey, is the Fed doing money printing?
Right.
So I'd love for you to just comment on that really briefly. But yeah, I have seen, I have seen. So you and Michael have just so we don't cover territory we already have recently in recent videos, weekly market recaps. I think both you and Michael have said, hey, look, the Fed doesn't print money. It's actually printed through the banking system. The banks actually, sorry, the banks create money through the banking system. The Fed actually creates reserves, not actual currency.
Yeah.
Um, let's not cover that territory. But what the Fed has announced it's going to do is freeze the size of its balance sheet
Mhm.
and let the mortgage-backed securities roll off. And therefore, as those roll off, that would shrink its balance sheet. So to keep its balance sheet at its current level, it's then going to step in and buy treasuries. And I
Right.
think, and the Fed is saying, but that's not really QE, guys. And I think some people are saying, is it?
Oh,
Is
it's
it not
QE.
truly? So
Well,
what
no,
do you
it's
think?
so
You think it is
so
QE?
first, yeah. So first of all, so real quick, let me you're let me clarify a couple of things because there's some things behind the article today that are important to understand. And this has been something that we've been kind of writing about for a while. So last week, sorry, 2 weeks ago, I wrote this article. I'm going to share a couple of screens with you just so everybody can kind of be up to speed on what we're doing here. Um, so 2 Fridays ago, I published this article called Money Supply Growth, a Thesis with a Fatal Flaw. So this has been one of the primary arguments about, oh, the money supply is just going like crazy, and this is the whole world's going to collapse because of this increase in money supply and the whole debasement argument, et cetera. So we pretty much just went through and explained how that money supply has to grow with the economy because if it doesn't, the economy can't grow. And as long as the money supply isn't growing faster than the economy, you don't have debasement. Debasement only occurs when money supply grows faster than GDP. And so we go through and explain all this exactly why we talk specifically about the sectoral balances of what happens with government debt when it gets moved into the economy and how this all works, right? So we went through this debate. So a guy named he writes on Substack, super nice guy. I'm not, I have all the admiration for him in the world, so I don't want anybody to think that, I don't, appreciate, good counterpoints. He wrote a piece last week, saying, well, no, yeah, I understand your whole point about M2, but the Fed's print don't discount the Fed printing money. And I'm like, the Fed doesn't print money. The Fed creates reserves. And so we went through it explaining, how exactly, there's two ways that money gets created. And we have the deficit funding process, which is where the government needs revenue for the government to spend, which winds up in household bank accounts. That's done through issuing bonds. That creates money. And then we have the other side where banks use reserves to create money. But the only way that money gets created, as we talked about before, and again, we don't have to rehash all this, is that money gets lent into creation. Nobody's up there with a printer cranking out money. This is kind of one of the, there's all these pictures of, Ben Bernanke with the money printer, right? Just printing out money. And
Powell.
that doesn't really happen. And so we just go through this explaining how money gets into the system. And most importantly, one of the other kind of arguments that gets thrown around a lot, well, when the Fed creates reserves, that doesn't wind up back into the markets. Yes, it does. because when the Fed creates reserves, who borrows those reserves? And this goes with the overnight repo process. So this weekend's newsletter on the website, which will be out tomorrow, is all about the repo issue going on right now. And I'm just a very basic overview of what the repo system is, because a lot of people don't understand what the repo system is and how it works, and who uses it. And who uses the repo system? Yes, the banks use it, but also hedge funds.
Yeah.
So,
We should really go through that, I guess, in 2 weeks when you're back on in 2 weeks,
yeah,
because I
we
think
can.
it's really important for folks to
Yeah, yeah.
understand.
So we can. But anyway, so this article is on the website right now, just kind of going through, how the Federal Reserve creates reserves, and it's just an asset swap between the Federal Reserve and the banks, and then the banks use the reserves to create money through lending.
Yeah.
So that's kind of where we are. I don't know if I answered your question, but if you want to read
Well,
the
you
article,
didn't.
it's on the
You
website.
didn't. You kind of did the opposite, where I said, let's not walk through all that because we talked about it already. But it's good, and
Yeah,
folks now know they can go to this article and get
yeah.
all the details on the plumbing. But now that the Fed is letting the mortgage-backed securities roll off and is having to step in, and now and a reminder, folks, I mean, the Fed has been buying Treasuries as it's been winding down QT because it's been managing the pace of the QT wind down.
So
But a couple of
you
years
would
ago, the Fed was by far the biggest marginal buyer of treasuries. It's been out of that game for a long while. It's now starting to step back in. So the question to you, Lance, was, is this really a form of QE, even though the Fed
yes.
doesn't want to admit it?
Well, there's actually two things that are coming on that are about to happen that are going to be equity positive. So first of all, so just a real quick explanation, I think, just to make sure everybody kind of is on the same page with you. We were doing 25 billion a month in quantitative tightening. So the Federal Reserve every month would let 25 billion dollars worth of their bonds mature off their balance sheet. And but there was a lot of articles written as like, oh, the Fed's still doing QE because they bought $50 billion worth of bonds last month, right? Or whatever. And that's true because they had 75 billion mature, they let 25 billion roll off, they bought 50 billion. So they were keeping this balance sheet roll off
Right.
at a
They
steady.
were managing the pace of QT. Yes.
Correct. So very important that the Fed has still been buying bonds. It's just
Yeah.
not they're not selling bonds either. They're just letting bonds mature off their balance sheet. So, and it's you made the exact point earlier, and this is actually all part of the repo article this weekend in the newsletter. I go through this exact question that you're asking is there's two things that have now happened that are going to be equity positive. The first is the government shutdown. And everybody's like, well, how's the government shutdown positive? Well, the government's not spending money. The TGA account that's a Treasury General account that has surged to almost $1 trillion. There's about a $700 billion increase that's growing every day here because of this government shutdown. It's money that's not getting spent. As soon as we flip on as soon as the government shutdown ends, immediately that money has to go out to everybody that gets brought back to work, gets all their back pay. Where does that money go? It goes into the banks. All the contracts that the government was doing, those get funded. That money goes where? Into the bank accounts of those companies.
Right.
So that
Corporate
money,
America into the banks. Yeah.
yeah, yeah. So it all winds up into the bank accounts of these money. So when that 700 billion hits the banks, which it will, immediately that increases the liquidity of those banks and those reserves of the banks, which they can then fractionally lend out. Now, again,
Right.
who borrows that money? Hedge funds. Hedge funds borrow in the overnight window. So they can immediately go to that repo window and start borrowing money, and that just increases liquidity in the system. So to your point, there's two things that are going to happen is that and part of the reason why the Federal Reserve ended QT so quickly, we expected them at the meeting. We had said this earlier this year that we expected QT to end this year.
Hmm.
And we just didn't expect it that they would announce it at their meeting and then end it in the same month, right? Well, I figured they would say, "Hey, we're going to end QT by next April," right?
Right. Or
But
end of
they
the
ended
year or
it
whatever.
end of November, and it's like we're ending QT end of the month,
Hmm.
and that's because of what's happening in the repo market. There is some stress occurring in the repo market, liquidity issues in the repo market that are very reminiscent of what we saw in 2019, and the Fed wants to be ahead of that.
Yeah.
So you've got a couple of issues here that are going to be providing liquidity to the banks in forms of reserves, right? And it's not QE, but it's going to act like QE by increasing bank reserves, which wind up back into the financial markets.
Okay. So as Michael Howe calls it, not QE, which is pretty
And this
much
is
effective,
technically not Q. No, this is technically not QE. It's just going to
but
wind up in the same place.
but it basically has the same effect.
Yes, it does.
Yeah.
So that's
Um,
also why we're not overly bearish on the markets right now.
well, okay. So, and that was my next question, which is, these are early signs of stress that we're seeing. How worried are you about them? Sounds like not that much.
Well, I'm bearish by nature, right? I'm always worried about this stuff.
Right, but
So
you just said you're not that bearish the markets right now because of
right,
that.
I'm not that bearish on the markets because I don't discount the fact that there's liquidity coming, right? So I know that's
Mhm.
coming. But yeah, but to say I'm not worried about stuff is yeah, I worry about this stuff all the time.
Well, but I mean, but this is new. How
Yeah.
much is this raising your worry needle, if at all?
It's look, I think the things I'm worried about are the fundamental factors. Economics, earnings growth expectations are too elevated, economic expectations are too high, valuations are too high. Those are all very problematic. Now, they're not problematic today, they're not problematic by the end of the year, but I think they become problematic next year. That's
Okay.
that's my assumption right now. Now that could change, but I think the headwinds are building into next year that I think we need to be prepared for. Again, like I said earlier this year, I expected earlier this year. I wrote that article that we talked about curb your enthusiasm because we just come off 20% year-over-year return years, and I said expect a year of higher volatility and potentially lower returns. Well, we got higher volatility, but returns have been great. So, I was wrong on the second part, but we definitely got the volatility. I still think next year we could see high volatility and lower rates of return because of the other factors that are still building in the system.
Okay. All right, folks. Well, you've heard it. Some folks call Lance a Uber bear. I think not too many people on this channel. You probably get more. You're too bullish, Lance, but I think you were just trying to be the eagle here. And the
Yeah.
eagle says 2026. It's not a lock.
Yeah. But it
Which
doesn't,
let me
but it
use a
doesn't mean
word.
we're not selling everything going to cash. I mean, we're just going to navigate it.
Yeah, not at all. Exactly. Yep. But I would say too, I will say too that another blockbuster year or another double-digit year of returns in the markets next year would be historically pretty aberrational, right? You don't usually
There's
get
also some
forward.
statistics. Yeah, there's also some statistics that we watch that certainly worry me about next year as well.
Okay. All right. Uh, Real quick, you were going through your charts and stuff there. So Lance, I was at this conference. A lot of your peers were there. A lot of people came up, who follow you, came up to me, and I will tell you first and foremost, Lance, not everybody agrees with you.
Of course,
Okay. Of
that's what
course,
makes the market.
not a huge surprise, not a problem. A lot do, but not everybody agrees with you. But pretty much everybody has a lot of respect for you in the terms that when you make an argument, you make it with data, right? You're not a guy who's slinging opinions. You're the guy who actually does the work, goes and finds the data, creates the charts, and says, here's why I think the way I do, and I'm going to try to prove it to you right now empirically.
Yeah.
People have a lot of respect for you for that, and I think it is very well earned.
Well, thank you. And look, and again, I don't know everything, and so when somebody poses an argument, that's why I go get the data and say, this is what the data says, and because again, that forms all of our opinions about how we manage money as well. And again, our job is to try to be right 70% of the time, and we're going to be wrong sometimes, but we're just trying to separate out kind of this fact from fiction. There's so much stuff that gets circulated around the markets that has no basis in reality, but it gets people all worried. And again, what your job is, and this is why you call it thoughtful money, right?
Mhm.
Is to be thoughtful about the things that we're being told and how we're letting that impact our investments, right? Because we're trying to grow money for retirement, we're trying to do these things. And so it's important that when you hear a narrative, no matter what it is, debasement or bull markets or bear markets or whatever it is, saying, okay, that's fine, but what's the real risk of that? And that's what I feel, and Mike and I both, that's what we feel our job is. And so if you read our articles on our website, they're answering those questions all the time. And every week we post 3 articles a week. We post newsletter on Saturdays. We also post on Substack at Lance Roberts. We post on Twitter at Lance Roberts. So all these, they're really easy to find. But you'll see a bullish article, and I get pushback on this all the time because like, well, Lance, just last week you wrote this really bullish article on the markets
Right.
about AI, and this week you've got this end of the world narrative about recessions and debt and deficits. And it's not, I'm not trying to make a case of why the markets are just going higher or why the markets are lower. I'm trying to just arm you with the information that says this is what the data says, and we need to try to navigate this together and try to make money. And everybody wants to argue and have fights and these type of things. And that's not me. I don't want to fight with you. I'm just like saying, okay, here's the data. If you disagree with it, it's fine. But it's just like a good example is this article that today about Fed money printing. Michael Garrett, great article. He disagreed with me, and so I wrote a rebuttal for him, just basically going through the data
Hmm.
and saying this is what the data says, and this is how this works in reality. And so it's just important that we all have a good base to work from.
Yeah. And look, a market is made by people who look at similar data but come to different opinions.
Sure.
And what I try to do with this channel, and you're exceptional at it, is get people on to actually make their case in full and wherever possible show the data so that you can look at it and then determine whose argument you find most persuasive so that you can then make a more informed decision. But I just want to, again, Lance, give you props for that.
Thank
All
you.
right. Another thing we could talk a lot about, I really just want to spend a minute on it. Um, Dollar outlook. In general, I believe you've been saying, yeah, look, the dollar weakened a lot over the past, couple of years versus other currencies, but you know, you think could actually start strengthening again versus them. You still have that outlook?
Well, the dollar's rallied this week. We were back over 100 on the dollar, and
Hmm.
the one, and this is, this has been my kind of my statement for a while is that it's like there was all these the word the world's debasing the dollar, and we're all leaving the dollar. Nobody wants to own the dollars anymore, and it was great. That was great narrative for pushing people to buy gold and those type of things. But that's in reality, that wasn't what was happening at all. And the dollar is going to trade either at a premium or discount to 100. That's just the way it works over time. And right now we're back over 100. The dollar's been having a very nice rally here lately because it was very, very oversold. And the dollar works just like every other commodity, works like every other stock, works like bonds, is that when things get really, really overbought, you're going to get reversals. Everybody gets on one side of the trade. When it gets really, really oversold, people are going to start buying it because they can make money in it. And so it's always important to try to set aside these narratives and just look at the dollar and just realize the dollar is a commodity that trades against other currencies. And when there's an imbalance, either it's overbought or oversold relative to those currencies, it imposes an economic impact on one country or another based on exports and imports.
Right.
So those countries are going to act to resolve that imbalance accordingly. And this is what we've been seeing as of late. The dollar's been rallying nicely from an oversold condition. It's getting a bit overbought here. So if you've been long the dollar trade, which we kind of recommended, 2 months ago, take some profits.
Okay. Are you guys doing that on your dollar trade positions?
We don't trade the dollar directly. We trade off of the dollar
Okay.
in the positions that we own. So our multinationals, those type of things that are impacted by the dollar, will be taken. We rebalance around the fringes because of that. That we focus on that dollar currency imbalance relative to the revenues.
Okay. All right. So how it'll impact those countries, companies. Okay. One of the reasons why I just wanted to touch on that was A, to get an update on what your thinking was, but also we don't have time to go into it here. But folks, if you have not watched the interview that I released right before this one with Lance, with Brent Roberts that I recorded when I was at the New Orleans conference, highly, highly recommend you should. It is a mind expanding, mind opening, perhaps mind blowing discussion around, Brent is the dollar milkshake theory guy. So he's the one who generally says, look, don't count the dollar out, even though, to your point, Lance, a lot of people are saying its days are over and nobody wants it anymore and all that stuff, right? So he's got the whole dollar milkshake theory. You probably heard him discuss in this channel a number of times. He now has looked at stable coins and, in my opinion, sort of had a eureka moment about how they could become they may well become the vehicle that not only maintains the dollar global dominance, but actually expands it dramatically
Yeah.
and would be a re-dollarization of the rest of the world, or an increasing dollarization of the rest of the world, not a de-dollarization. And Brent's the first one to say he's still thinking this through. But spending some time with him and some other thinkers this week, really going through it, my mind just kept like every discussion I had with him, I was like, wait a minute, that opens this other massive
Yeah.
opportunity or question. It really is. You owe your if this is something that you have even marginal interest in, I think you really owe yourself to just listen to the discussion, and then afterwards decide for yourself whether you think it has merit or think it doesn't. But if it does, if Brent is right here, this is, I mean, really kind of like a new monetary regime for the world. It's at that level of importance. But anyways,
No,
um,
he's absolutely right. It's also a huge tailwind for U.S. Treasuries too.
well, it absolutely would be. And I mean, it would eventually. This is really the Treasury doing all this, and this could replace the euro dollar market over time. It
Yep.
could replace the SWIFT system. It actually has implications for the banking system.
Yep.
So you may not actually, well, the Fed's importance may diminish a lot in this way. I mean, there's just all these different things. And of course, if we're doing this internationally, is there a reason why we wouldn't do it domestically? Probably not. If we did, all those concerns about a CBDC in terms of
Yep.
privacy and control, all that stuff comes into play. I mean, it is a massive, massive tangle of really interesting
It
implications.
is.
So
No,
I'll
and,
just leave
and
it at that.
And no, we absolutely agree with him. Mike and I wrote this article called "Stable Coins to the Treasury's Rescue" back in June of this year. So he's absolutely right. This is something we've been looking at now for the last 6 months, is the impact of stable coins. In fact, I just interviewed a guy from a cryptocurrency company that'll be airing on Monday on our Real Investment Show, but part of our conversation is around digital treasuries as well as other factors. So yeah, the future of what happens with stable coins is going to be massively important to the strength of the dollar and the treasury market.
Okay, and folks, I bring this up just because I think for most people, they kind of heard of the word stablecoin. They don't really know much about it or
Right.
care about it, and they sort of think about it as like a fringe of the whole crypto space that they're maybe not even really looking at anyways.
Mhm.
This is something I think you need to really look at because it could have, like I said, just massive implications, way bigger than I think most people are imagining right now.
Absolutely.
Okay, so go watch the video with Brent. All right, let me move on to this next thing real quick. I didn't mean it to be the rant, but it might need to be the rant just because we're starting to get short on time. It's just a comment that was made below one of my recent YouTube videos that I thought really captured the gestalt of how the middle class is feeling right now in terms of their frustration about their financial situation. He said, if you have $0, you get welfare. If you have $1 billion, you get a bailout. If you've got 2,000, you get to fund the whole system and get lectured about how to budget your money better. And
Great point.
I did think that was a really effective, concise capturing of the frustration and the plight of what remains of the middle class here, Lance. And so, one, I'm sure you probably have a reaction that I'll let you go on in a second, but I well, let me get your reaction, and then I want to ask the question I was going to ask.
Well, no, I mean he's right. I mean, the reality is that if you've done well for yourself and you're in the top 5-10% of the economy, you get a lot of support from, the growth of your dollars because you're investing, you're taking advantage of markets, you're doing these type of things. He's right. If you're in the bottom 50% of the economy, again, the wealth charts show this, and is that, you look at the wealth gap between the bottom 50% and everybody else, they barely show up on the charts, right? In
Right.
terms of equity wealth. So yeah, and they're getting welfare, they're getting support, they're getting, food stamps. Well, not right now, but they get food stamps, they get all this other help. And if you're in the middle class, just paying the bill. I saw a great TikTok this week. There was this lady, she was crying on TikTok and she was like, "It's your responsibility to feed my 5 kids," because
Right.
she didn't have her SNAP. And so a guy did he was responding to it and it flips over to him. He's out in the middle of an oil well. He's like, "Lady, I'm working on it. I'm working on it." And he's out there working hard. And that's true, is that the kind of that bottom, between 50% of the economy and 80% of the economy, those are the guys that are working hard, paying bills, trying to make ends meet, but there's absolutely nothing left over for investing or doing anything else. They're just trying to get by.
Yeah. Charles Hugh Smith has a term of long uh, used called, tax donkeys, where that's just how the middle class feels, right? where they're like, we're doing all the work, we're paying a crap ton of the taxes, we're not getting any real tax breaks, right? And getting ahead is getting harder and harder and harder. That's not news necessarily to anybody, but having been at this conference that is a investment conference, and it's the people who are paying attention and really trying to get ahead, right? Not get left behind, not be stuck forever in tax donkey status. Um, we're in the business, Lance, where we talk to a lot of people all over the wealth spectrum, and my heart is increasingly going out to people who, I mean, of all age ranges, as we talk about, but really to the people who are kind of 40 through 60, who are just working hard. They're getting squeezed by the forces that you just talked about, and many of them are aspiring to have $1 million, right?
Sure.
And for a lot of people, like, and I know this might be hard to believe for some listeners, and maybe even insulting for some listeners, but like $1 million doesn't go as far as it used to go to, right?
No.
So when I see these people who are like, look, I want to get $1 million so I can retire by age 65, I'm thinking, well, let me just do some math here. Like, I mean, you better have no mortgage at this point in time. You better have a pretty low cost footprint to make that last the next 25 years of your life,
Right.
right? And for a lot of people, you tell them that, and I understand. They're like, I mean, $1 million almost feels like impossible for me to get to right now. And you tell me if I get there, it's not even going to be enough, right? And I'm not trying to depress people, and I think there are many ways to still have a very happy, fulfilling life, even if you don't get to the $1 million status level. But I did just want to kind of lean back for a moment and look from a high level to just say it's getting hard for, I mean, everybody who's not in that top 10% that owns the vast majority of all the world's, financial
Yeah.
assets. But it's getting hard. People can feel how hard it's getting, but I'm not even sure they appreciate how hard it's getting numbers wise.
Well, and again, but this also goes back, and see, I find it very fascinating. So we're gonna have our conference on January the 17th. You're gonna come down. It's gonna be great. We're gonna meet a lot of people. Got some really cool speakers this year on cryptocurrency and the future of artificial intelligence. Got a guy from BlackRock coming on artificial intelligence. It's gonna be absolutely awesome. Um, but there's a very defined group of people that attend a financial conference. And it's people that are serious about investing, serious about saving. And it's always interesting when you look at the top two reasons for divorce, it's infidelity and financial and finances, right? And
It
generally, if you have
is.
trouble with the finances, it leads to the infidelity. So you really put finances probably at number one because it's probably at the root cause of everything else that's
Hmm.
going on. But the problem is like, look, we meet with people all the time that have $500,000 saved up and they can retire because they have a very normal living standard. They're not driving fancy cars. They drive an old beat up pickup truck and they live in a normal house and it's they have a very moderate lifestyle and they can retire with between that and Social Security and whatever other little trinkets they've saved up over time they're able to retire and they can do okay. So your retirement is only a function of what your monthly cash flow needs are, right? And so, if you're going, well, I need $1 million to retire, well, maybe you do, maybe you don't. Look, I will tell you for a fact, I just met with a guy 2 weeks ago that had $20 million, cannot retire. No way he can retire. Probably will never retire because his cost of living is so far above and beyond what $20 million can generate. He'll never be able to get there.
Right, right. Yeah,
Right.
and there are people like that. It will probably play the tiniest violin for them, but yes, there are
Yeah,
people
yeah,
like
yeah.
that.
But my point is that part of what our job is, your job in particular, because you interview a lot of people, and my job and what I do is to make sure we have realistic expectations of what retirement's going to look like, but more importantly, that we're doing what's necessary to get there. And again, I've talked about before is that so many people, they get up in the morning, they go to work, and they're doing all these little things that are just eroding their financial capability to save and invest money. Just things like I stop for Starbucks every day and I get a Starbucks on my way to work. That's $5 a day that's just leaking out of your savings. And you start thinking about all these little things you do. And this is why it's so important to have a financial plan and do some budgeting and take control of your financial
Yeah,
situation.
it is why the plan is so critical. Yeah.
Yeah. And we do more, more people could retire with that 500,000 or $1 million if they were willing to do the work today. And instead of doing the work and accepting responsibility, I see so many people, I talk to so many people, they blame everybody else. It's the system, it's the economy, it's capitalism, it's this, it's that, it's everybody else, and it's everybody else's fault but my own. But in reality, it's all our fault. It's my fault. It's Adam's fault for ourselves, right? What I do in my life with my family is my fault. And if I don't do what's necessary to build wealth and do the things to take care of my family, it's my fault. It's nobody else's. And I can fix my situation if I'm willing to take responsibility and start taking small actions today. And again, we don't have to go through massive extremes. And this is why people fail on diets all the time, right? They go, all right, Adam, I'm going to start a diet, right? So I'm going to do your fasting diet for, a
Hmm.
week. I'm not going to eat for a week. And then, by the end, they go to this massive extreme, and you can't change habits overnight like that. It takes time to change a habit. Adam and I go through fasting, we go to the gym, we work out, but that's stuff that we didn't just start doing overnight. These are things that we've built routines and regimens around, and we've built structure around, and it has become a habit in our lifestyle. The way that Adam and I eat, those are habits now. Those aren't I have not been on a diet in 10 years, 20 years, right? Unless my mom, unless my wife puts me on one of some sort, right? She's,
Yeah.
I'm doing the Mediterranean diet. Okay, honey, I'm with you.
But you've
But
learned how to make better bad decisions around your
yeah.
food over
And,
time.
and,
Yeah.
and, and so when I'm making a choice to eat, if I'm going to eat a hamburger, which I do every now and then, I just cut the mayo, cut the cheese, right? It's just small things that can lead to better outcomes. And so it's the same thing with finances. Don't try to jump off the cliff and just, okay, I'm going to cut it down to the bone and I'm going to save everything else because you're going to be miserable and it's not going to work. You're going to wind up in a divorce. It's not going to be happy, but small changes. And the biggest factor is, if you're married in particular, is making sure your spouse is on the same page with you. If he or she is not on, if they're out there spending left and right and you're trying to save money, it's not going to work. Y'all have got to be on the same page and making sure it all works together. But if you can make small changes today and start investing, saving, we on SimpleVisor, we built an accumulator portfolio. It's very basic. You need about $1,500 to get it funded. Once it's funded, put in $500 a month, $250 a month, $100 a month, $50 a month, whatever it is. And we'll get that money allocated as it accumulates. And so it grows over time. But it's a way to get you started into that process and get that money growing for you. So again, there's all these tools available for you to help you start building wealth, but you've got to take responsibility and take the first steps.
So absolutely. And look, I didn't raise this to depress people and certainly not to like demoralize someone to the point of like, well, then why even try? Maybe it's a little bit more to light a fire and everybody just say, hey, look, is what it is. Maybe the mountain's a little bit steeper than we thought it was going to be or wanted it to be. Doesn't mean you still don't want to climb it to get to the top, to get to, the destination you want to get to. But to Lance's point, you got to take responsibility. You got to avail yourself of the tools that are out there. As we said, it really all starts with the planning. And that's the key thing here, right? Is you got to have a vision, a goal, and you got to have a realistic way to get there. And once you have the goal, then you can start really making intelligent decisions around the leverage you have to pull. Okay, well, if I'm not on track to get there, what do I want to do more of? Do I want to make more? Right? Do I want to be able to save more and put that away towards investing? Do I want to invest that in such a way that I can have more confidence in the return that it's going to have for me? Or is it on the spending control? Right?
Yep.
So to your point, Lance, yeah, you could retire on $500,000. You're going to be able to do a lot less things
Sure.
perhaps than somebody who retires with 5 million. And that's not necessarily a bad thing if you've constructed a life that you've liked. But I can tell you that if you're going to retire with $500,000, if you haven't really gotten serious about your like reducing your cost footprint in ways that are sustainable, you're going to have some nasty surprises down the road if you run out of money, right?
Absolutely.
Yeah.
Absolutely.
Yeah.
And again, and don't go into this idea with, oh, I'm going to get to $1 million. Don't do that. This is the same problem with dieting and exercise, right? I'm going to start exercising, and in 6 months I'm going to look like Arnold Schwarzenegger. That's not going to happen, right? But
Right.
instead of
Or it's not going to happen overnight, but yeah.
exactly. And so don't go out there with this massive goal of $1 million. It's so far out there, right? That's decades down the road to get there. Start out by, hey, you know what? This year I'm going to save $5,000, 10,000. Pick a number, whatever's reasonable for you. But pick a reasonable number. Even this month, this month I'm going to save $1,000 this month or $500 this month, whatever it is. But pick a number that's reasonable that you can obtain. Because once you obtain that number, hey, I feel good about myself. I achieved a goal, right? I got out of bed this morning and I achieved a goal. I saved $500 a month. Hey, let's try 600 this month, right? Let's try
Right.
to bump that up a bit.
Yeah, get
Try
competitive with
700.
yourself. Yeah.
Yeah.
So
And
I agree. Although what I would say is actually start with it with not an end goal, right? I want to retire with $1 million.
yeah,
Say I want to get to X by next year or the year after, right? And
absolutely.
then come up with your number per month, right?
Yes.
What's an achievable, a realistically aggressive, target to try to hit every month. And then once you start hitting it, to your point, then start getting in competition with yourself. All right, I'm
Yeah.
putting five away every month. Well, let's see if I can get to six, right? Let's see if I can pull that midterm goal in by a couple of months, right?
Yeah. I'll tell you this, I have met with so many couples that have done exactly this. And what's so funny about it is like they come in, I meet with them, they're not saving a penny, right? And I'll meet with them a year later. Their account's grown now, and their total view is like they're in together, right? They're in there trying to figure out all these different ways to save extra money to try to increase their goals. They're selling everything that's not nailed down. They've
Yeah,
quit doing all these wasteful habits that they used to have, but it
right.
becomes a competition, and they're more
Well,
excited
well,
about
but they're
seeing.
on the same team in this
Yeah,
competition, which is the
and
best
they're
thing. Yeah,
seeing and they're being rewarded by seeing their account balance grow, and they're seeing that number go up every month. They see, hey, I'm actually achieving something here. I've gotten out of credit card debt now. I feel so much better. It's so freeing once you can actually just start getting control of your finance. Again, you don't have to be a multi-billionaire, right? That's not the goal for everything. It's just getting control of your financial situation will make you so much happier because you're in control of it rather than it controlling you.
yeah, and the motto for thoughtful money is to help people fund make better decisions to be
Yeah,
able to fund their life goals, right? I'm not saying make life decisions so you can sit in a big pile of money. It's so that you can do the things in life that are important to you, right?
that's right.
And
That's
in
right.
most cases, they're not going to be monetary related at the end of the
That's
day,
right.
anyways, right? Okay, so it's so interesting, Lance, because we're getting into the territory now of what I was going to make the rant. We'll save it mostly for a later day, but I'll just conclude by saying, to your example there about the couples. My wife, now that we're empty nesters, my wife has started being able to travel with me when I go to conferences, and it's new and novel, but it's a lot of fun. And so when I was invited to the New Orleans conference, I told the team there, they said, Adam, you want to do a workshop? And initially I said, no, that's not really my bag. But then I said, actually, my wife's going to be with me. And we're going to this money show where everybody's super focused on money. But to your point, Lance, money issues are the number two
Yep.
reason for cause for divorce, right? And at these money shows, there's never any discussion around the importance of money in our relationships, right? And whoop, I just lost you, Lance.
Sorry, I had to blow my nose. Keep talking.
Oh, okay. So I didn't know if that was your. Okay. Three, two, one. And it's just struck me as sort of so odd that we will all go to a conference to talk about making money, right? But we don't actually talk about how it's going to impact our lives,
Right.
right? And so I tossed out to the guys who were running the conference. I said, "Hey, look, kind of a tangential idea, but my wife's coming. She's a couples therapist. Um, what if we put on a workshop about how to talk about money in with your spouse without blowing up your relationship?" And they were like, huh, I don't know. It sounds kind of, I mean, yeah, I guess it's relevant. I have no idea if anyone's going to be interested, but sure, let's put it on the program and see who shows up. So my wife and I, we were like the last workshop, the last day. We had five people come in, and we were like, all right, I guess we're going to do this with five people. Fine. We're just trying this out anyways, right? And then within the next like 10, 15 minutes, probably like 25 more people came into the room. So it actually was pretty well attended. And it was really interesting, and I'll save most of the learnings for the next time we talk about this. But one thing that was really interesting is I asked and most people were there by themselves. You know, they were the money person in their relationship. They came to the conference, their spouse
Yeah.
was back home. But we did some interactive workshopping. And one of the things I asked them to do was, hey, like, what's all this money for in your relationship? Like, what is your why? As a couple, what do you think your why is around your money goals? Like, why are you guys scrimping, saving, sacrificing to make all this money for the future? And so I had everybody share their why with the person next to them. And then I asked them, all right, look, if your spouse was here and they were asked the same question, do you think they would have given the same answer you did? And way more people than I had expected said, no. Now that I
Yeah.
think about it, I don't think they would have.
They
Right?
would have.
Meaning couples are just so oftentimes not on this, they're either not on the same page or they're just not talking about this, right?
Right.
And that to me, I mean, I shouldn't say it surprised me. I was sort of expecting, I guess, more or less of a mismatch, but it's so crazy that, you know, we lock ourselves with somebody on this journey and we're all going to work in the mornings and we're, you know, having fights around money, whatever. And yet we might not have actually just set the groundwork at the start of, wait a minute, what are we doing all this for?
Yeah.
Right?
It's
What
funny you
targets
bring
are we
that.
trying to hit?
No, it's great. It's really interesting you bring that up because my wife and I had this conversation right after we first got married. And, back when we first got married, life, wasn't as easy as it is now.
Yeah,
Things have gotten better over the years, but things were pretty tough back then. Just, making ends meet. She's
sure.
working, I'm working. We're just trying to pay bills. We're trying to raise four kids, get them where all they're supposed to be. And we had this conversation. I go, okay, I said, look, we have to do these things together. And she's very frugal. She's very mindful. She doesn't do crazy stuff with money. She's very good. And I said, well, what? I said, why are we doing this and what's the goals? And she said something to me at that time that has just stuck with me and it's probably made me work harder than I would have worked otherwise. She
Hmm.
says, look, all I need you to do is make sure that I'm safe, right? I just need to be able to raise our kids, make sure they have what they need, make sure they where they want to go and that they're safe. We're in a good neighborhood, we have good schools, safety. That's all I care about. As long as you make sure that we're safe and secure, I don't really care about anything else. And for her, that's all money is. It's safety and security. It's that, if something happens, she's got money to take care of it. If something, needs to happen, she can take care of it. If one of our kids gets, in bad trouble, she feels like she has the ability to control to take care of that. So safety and security for her was far more important than buying a Louis Vuitton purse or Gucci
Hmm.
shoes or whatever. Those are not even on her radar of what she wants monetarily. But safety and security is number one.
So, you know, what's interesting is that exact exercise I just mentioned to you. There was a couple there, and they were kind enough to share their answers with the room.
Yeah.
And the the wife said, I asked if the husband, you know, if his why was similar to hers, and she said, well, yes and no. She said he said security, right, just like you said, right? Male provider. I'm here to provide security. She said that is part of mine. So he got half of it. But the other half is that, you know, like life's to be enjoyed. I just don't want to be all about saving for tomorrow. I want to have at least a little bit to enjoy our lives together in the here and now, right?
Yeah.
And there's nothing wrong with that, right? But what's interesting is if you're a guy who's just laser focused on only providing, only security, you may be building some marital resentment because you're not taking a little bit of time to smell the roses. And I don't mean being wasteful with your money or whatnot, but to your point about celebrating the milestones as your bank account grows, generally you want to celebrate those in ways that don't slow down your progress, but you might want to take
Right.
a little bit and just say, hey, look, you know, let me take you out for a nice dinner, or, you know, let me just in some way, let's take a little bit of what we're working so hard for and make sure we enjoy some of it in the here and now because we don't know what tomorrow's going to bring, right?
So my wife and I do that. We have an account that's set up, just a savings account at the bank, no big deal. And every 2 weeks, when we get paid our salaries, it automatically extracts some dollars out of each of our paychecks and puts it in that savings account. And that savings account is my wife's travel vacation account because it's where she gets to pick where she wants to go. And then we go do that. So, like, she wants to go to Beaver Creek over Christmas and have Christmas at Beaver Creek in Colorado. Fine. As long as it's in that savings account, you can do whatever you want. Now, if you run out of money in that account, we're all sitting at home eating pasta, right?
Yeah,
So,
yeah,
but it is important that, and then again, it's important for her too to be able to, great, I'm contributing to my HSA at work and I'm getting my triple tax benefit for retirement on my HSA. Super important. You need to do this. If you have an HSA, you got to be funding that to the max, right? But for her, she's like, why am I funding all this? Right? Why am I doing that? It's like, honey, trust me, it'll pay off in retirement when we get there. You need to do this.
hmm
Fund your 401k plan. Why am I doing this? It's for your retirement. Trust me, get there. But for her, that's too far away. That's too far out there. This is like the $1 million goal. I want to get to $1 million, but it's so far out there, she can't see that far. So she needs, in order to keep her on track for savings, she needs that ability to have the reward, right? She needs that reward every now and then. And so we've set up this whole little account that gets automatically funded. And then we can go on a trip. We're going to go to, like I said, Beaver Creek and over Christmas. Next year, we're going to go see our son in the UK. So she gets to look forward to that. And she gets to see that money going into that account. And she goes, I know what that's for. I get to go see my son in 12 months because of that money.
yeah,
And so that gives her that ability to stick to the diet, so to
right.
speak, to get there.
Well, so kudos to you too. So it sounds like you've had the communication and earlier on enough in your relationship to understand each other and to put all this into place. Certainly what we kind of got, well, what my wife has gotten just from her day-to-day job, but what we got from this conference is, a lot of people haven't, right? And when one guy, and I don't want to oversell this, this
Right, right.
this was very generous, but one guy came up and said, this is the most important part of this conference to me. It's like, I don't know why we don't put this at the start of an event like this so that we kind of get why we're all here and then we get into all the money stuff, right?
Okay.
So,
That is a great
anyways,
idea. Bring your wife in January and we'll set up a workshop.
I mean, if you want to, we certainly could. We are going to kind of, this was sort of a little pilot, a little trial pilot just to see how this stuff would be received and whether folks thought it was useful or not. I think the initial feedback has been pretty darn good, like I mentioned. So anyways, we're going to start doing some small additional kind of virtual versions of this. So folks, if that's something that you have any interest in, either just let me know in the comments as usual, or you can literally just email support@thoughtfulmoney.com and just say, hey, I'd like to raise my hand for this. Just put me on a list somewhere, and when and if you do the first one of these virtual ones, let me know, and we'll include you in on it. All right, Lance. I'm trying to get us out of here before the 2 hour mark, so I totally
You
bungled
totally
my
blew it again.
promise to you to get out
You blew
early.
it again.
But I have not asked you about your trades, and I would get crucified, I think, by the audience if I did forget to do that. So, what, if any, have you done over the past week?
None this past week. We started building our position meta about a week or so ago. We're probably going to do some rebalancing in the portfolio next week. Maybe just taking in some of the gains that we've got. We'll do a little bit of tax loss selling. It's that time of the year, by the way. If you haven't looked at your portfolio, we're getting to that time of the year where you need to start considering if you're pushing up in age, you've got to do your RMD. If you haven't done your required minimum distribution out of your IRA this year, you need to start thinking about how to do that. Get with your advisor to get that done.
And that's is that 57 and a half or that's 70.70?
772 right now, but it goes up to
Yeah,
73 next year. So
yeah.
that's eventually going to keep creeping up. I'm not the expert on that. That's Danny or Richard, but anyway, you've got to do your RMDs on that. This is also the time of year to start thinking about your charitable donations and gifting. Look, you can give money to the government when you pay taxes, or you can reduce your taxes by giving money to a cause that you support. So you can kind of decide how you want your money spent. But if you're
Right.
going to make the charitable contributions, you're in the last 2 months of the year, so you need to get that done. And then you also need to start thinking about your tax loss sales for this year. Start thinking about your gains for this year that you've gotten a lot of stocks. You've probably got some losses in some stocks. You can sell some of those gains, offset that with some of your losses for tax purposes. So again, if you don't have an advisor, don't really know how to do any of that stuff, don't have to do charitable gifting, those type of things, certainly get with an advisor. Call Danny or Richard at my office. They can walk you through it. They know that stuff inside and out. But you definitely need to start thinking about getting some of that stuff done. It's also by the way, very important, Roth conversions for this year. You need to get that done before year end as well.
They have to be done before year end,
Yeah.
not before end of tax.
Well, you would be best if you're going to do the Roth conversion is do all this as you're kind of wrapping up this tax year. Because again, that part of that Roth conversion is going to be your tax loss sales
Got
also.
it. You want to use those, yeah,
Yeah.
against any gains. Okay, great. So I would agree with everything Lance just said. I would just add on to it, if you do not have a financial plan or if you have not looked at your financial plan in a year or longer, also update that. And if you don't have if you're DIY and want to do it all yourself, great. Do everything Lance just mentioned on your own. But if you want some help, and I think most people watching this video probably would benefit from professional help on this, then talk to your advisor or talk to Lance and his team there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out. And then the firm you're matched with, or if you just say, hey, I want to talk to Lance specifically, you can do that too. They'll be right in touch with you. Um, all right. Well, look, folks, if you think the best way to marital bliss in your finances is to sit down with your spouse and watch Lance Roberts on this channel week in and week out from here on out, please let them know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. All right, Lance, as usual, I'll let you have the last word.
No, look, there's lots of moving things going on in the markets right now. Nothing worth panicking over yet, but certainly stuff worth paying attention to. So again, we'll just kind of navigate this as we go. But as we get into the last, kind of this last few weeks of the year, expect higher volatility. Expect there's some things to potentially not go the way you think they're going to go, and just make sure that you're paying attention to it.
All right, my friend. Have yourself a great week. We'll see you in 2 weeks. Hope the
Yes,
next
sir.
treatment goes great for your wife. Know that
Thank you.
she's got all our thoughts and prayers, and we're wishing you guys all the best.
Thank you very much. I appreciate that.
All right, and everybody else, thanks so much for watching.